Hello and welcome to our in-depth analysis of why the U.S. Federal Reserve raises interest rates despite financial turmoil. The decision to raise interest rates is a complex and highly debated topic, especially during times of financial instability. However, there are several reasons why the Federal Reserve may choose to increase interest rates, even when the economy is facing challenges. In this video, we will delve into those reasons and provide a comprehensive understanding of the Federal Reserve's decision-making process. To understand why the Federal Reserve raises interest rates, we first need to understand what interest rates are and why they matter. Interest rates are the cost of borrowing money. When you take out a loan or use a credit card, you are charged interest on the money you borrow. Interest rates also affect savings accounts and investments, as higher interest rates can lead to greater returns on those investments. Interest rates are also a key tool for the Federal Reserve to manage the economy. The Federal Reserve sets the target range for the federal funds rate, which is the interest rate at which banks lend money to each other overnight. The federal funds rate influences other interest rates, such as mortgage rates, credit card rates, and auto loan rates. By setting the federal funds rate, the Federal Reserve can influence borrowing and lending throughout the economy. The Federal Reserve is responsible for maintaining economic stability and promoting full employment. To achieve these goals, the Federal Reserve has several tools at its disposal, including interest rates, open market operations, and reserve requirements. One of the primary objectives of the Federal Reserve is to control inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and it can have a negative impact on the economy if it gets out of control. If the Federal Reserve sees signs of inflation, it may raise interest rates to slow down the economy and keep inflation in check. Another key role of the Federal Reserve is to promote full employment. The Federal Reserve tries to maintain a level of unemployment that is consistent with a healthy economy. If unemployment is too high, the Federal Reserve may lower interest rates to stimulate economic activity and job growth. Conversely, if unemployment is too low and the economy is overheating, the Federal Reserve may raise interest rates to slow down the economy and prevent inflation. Now that we have a basic understanding of the Federal Reserve's role in managing the economy, let's look at some of the reasons why the Federal Reserve might choose to raise interest rates during a time of financial turmoil. First reason: controlling inflation. As we mentioned earlier, one of the primary objectives of the Federal Reserve is to control inflation. During times of financial turmoil, inflation can become a serious concern. Economic uncertainty can cause businesses to raise prices to offset potential losses, and consumers may hoard goods and services, leading to price increases. To combat these inflationary pressures, the Federal Reserve may raise interest rates to slow down the economy and reduce demand. Second, attracting foreign investment. During times of financial turmoil, foreign investors may become nervous and start to withdraw their money from the markets. Raising interest rates can help to reassure investors that the Federal Reserve is taking action to stabilize the economy and can help to prevent a panic. Additionally, when interest rates are high, foreign investors are more likely to invest in the United States, as they can get a higher return on their investment. This can lead to increased economic growth and stability in the long run. Third, stabilizing the financial markets. Financial turmoil can cause investors to panic and start to sell off their investments. This can lead to a downward spiral in the financial markets, with falling prices and a loss of confidence in the economy. To prevent this from happening, the Federal Reserve may choose to raise interest rates to provide a sense of stability and reassurance to investors. Higher interest rates can also make investments in the U.S. more attractive, as investors can earn a higher return on their investments. Fourth, strengthening the U.S. dollar. During times of financial turmoil, the U.S. dollar may weaken as investors seek out safe haven currencies. This can lead to a depreciation of the U.S. dollar, which can have negative consequences for the U.S. economy. Raising interest rates can help to strengthen the U.S. dollar, as investors will be attracted to the higher returns available in the U.S. This can help to stabilize the economy and prevent a further depreciation of the U.S. dollar. Finally, preventing asset bubbles. During times of financial instability, investors may seek out risky investments in search of high returns. This can lead to the formation of asset bubbles, where the prices of certain assets become artificially inflated. When these bubbles burst, it can have a devastating impact on the economy. Raising interest rates can help to prevent the formation of asset bubbles by making it more expensive to borrow money for risky investments. This can help to promote a more stable and sustainable economy in the long run. While there are several reasons why the Federal Reserve might choose to raise interest rates during a time of financial turmoil, there are also risks associated with this decision that can lead to a variety of risks and negative consequences. Some of the potential risks include decreased consumer spending. When interest rates rise, it becomes more expensive for consumers to borrow money. This can lead to a decrease in consumer spending, which can slow down economic growth and potentially lead to a recession. Increased borrowing costs for businesses. Higher interest rates can also make it more expensive for businesses to borrow money, which can make it more difficult for them to invest in new projects or expand their operations. Higher interest rates can lead to higher mortgage rates, which can make it more difficult for people to afford homes. This can lead to a slowdown in the housing market, which can have ripple effects throughout the economy. Currency appreciation. If a country raises interest rates, its currency may appreciate in value relative to other currencies. While this can be good for consumers who are traveling abroad, it can be bad for exporters, as their goods become more expensive relative to other countries' goods. Governments also borrow money, and higher interest rates can lead to increased borrowing costs for governments. This can make it more difficult for governments to finance projects and services, which can have negative effects on the economy and society as a whole. Potential for defaults. When interest rates rise, borrowers may have difficulty repaying their loans. This can lead to defaults and bankruptcies, which can have negative effects on the economy. Overall, raising interest rates during a time of financial turmoil is a delicate balance between stimulating economic growth and avoiding inflation, while also mitigating the risks associated with higher interest rates. Central banks must carefully weigh the potential benefits and risks before making any decisions to raise interest rates.